Welcome to an exciting adventure where we'll learn some fascinating facts on stocks and bonds and have a lot of fun along the way. I'm your guide, and we're about to embark on a journey through the realms of knowledge. Let's start Kountin Koins. Were you aware that as the company prospers, your ownership stake increases? And you might also become eligible to receive a portion of the earnings through dividends? Investing in stocks transcends mere ownership. It entails actively participating in the company's journey. Whether it's a tech behemoth reshaping the world or a fledgling startup with grand aspirations, you are part of the adventure. Now, let's talk about bonds. Bonds are like a loan from you to a company or government. It's not as thrilling as owning a piece of a company, but it has its own charm. Think of it as lending your money in exchange for regular, predictable interest payments. It resembles a comfortably uneventful financial connection. When you invest in bonds, you become a creditor, and the company owes you a debt. In return, they promise to pay you back with interest. This can be a fixed, regular income, which is a bit like receiving rent from your financial property. Bonds can be your safety net. They provide a predictable cash flow, making them a popular choice for retirees or those looking for steady, low-risk investments. When it comes to potential earnings, stocks are all about unpredictability. Your emotions can swing from despair to boredom to euphoria. On the other hand, bonds offer a predictable income with limited downside. It's like knowing what you'll get on a roller coaster versus a calm carousel ride. Stocks can be a thrilling gamble. Your investment can skyrocket, providing financial freedom and exhilaration. But it can also plummet, leading to sleepless nights and heartache. On the flip side, bonds offer a sense of security. You know what to expect, and it's like a steady, dependable friend. Even in turbulent times, bonds can be your financial anchor. If you want to sell your publicly traded bond before its term ends, the market can be a bit like a seesaw. Bond prices fluctuate with changing interest rates. If rates rise, your bond might not look as attractive and its price could drop. If rates fall, it becomes more attractive and the price can go up. When interest rates go up, existing bonds with lower fixed rates become less appealing, which can impact their market price. This is like the law of supply and demand in action. Conversely, when interest rates drop, your bond with a fixed interest rate becomes more attractive. Investors are willing to pay more to get their hands on a bond that offers a higher yield than new bonds. This creates a demand that pushes up the bond's price. To invest in bonds, you need to be a detail detective. It's all about reading that fine print, terms, conditions, risks, and collateral. You'll end up on the right side of the company's balance sheet. So make sure the left side is solid. Understanding the bond's credit rating is crucial. A higher rating indicates lower risk, and lower rated bonds can offer higher yields but come with increased risk. And remember, bonds can be like a puzzle. You need to ensure the pieces, like the interest payment schedule and the company's financial health, fit together seamlessly. For stocks, it's a mix of vision and spotting red flags. You need to visualize the company's future and assess its potential. But you also need to spot the CEO's behavior, reckless or out of touch. Avoid those stocks. Analyze the company's financial statements. Look for growth potential and keep an eye on industry trends. Being able to separate the promising stocks from the risky ones is a skill worth honing. What if your investment goes south? If the company goes bankrupt in the bond world, you might recover some of your investment. But with stocks, if the company crumbles, you could lose it all. Why? Because bondholders have priority in line, while stockholders are last. That's why bonds are considered less risky. Bonds are considered safer because bondholders are higher up in the pecking order in the event of a company's bankruptcy. They have a better chance of getting back some of their investment before stockholders even see a dime. But don't let this lull you into complete complacency with bonds. Even if you recover some of your investment, it may be a partial amount, especially if it's a riskier bond. It's essential to diversify your bond portfolio to minimize risk further. Spread your investments across different bonds to avoid overconcentration in one issuer. Regrets? Oh, They can happen in both worlds. In bonds, put only some of your money in one basket and always keep a cash buffer for emergencies. In the stock realm, avoid reckless leverage that can magnify gains but also magnify losses, and steer clear of short-selling stocks, which can lead to devastating short squeezes. Remember that over-concentration in a single bond can lead to regret if that company runs into financial trouble. Diversify your bond investments across different issuers and industries can help spread risk and reduce the potential for significant losses. Building an emergency cash buffer is essential in both bond and stock investing. Unforeseen expenses or opportunities may arise, and having some liquid funds at your disposal can prevent financial stress. And speaking of avoiding regrets, be cautious when it comes to leverage and short selling in stocks. While they can amplify gains, they can also amplify losses, leading to financial disaster. It's a high-stakes game that's not for the faint of heart. What an adventurous ride through the realm of stocks and bonds. We hope you've had as much fun as we did exploring these financial frontiers. Share your experiences with us in the comments below. Stay tuned for more insights and expert advice on the Kountin Koins channel. Until next time, keep counting those coins and chasing your financial dreams.